Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous? Do you ever stay awake, counting sheep like all the time? What's your life like? What's your purpose? When's your birthday? What's your sign? Are you down right now? Are you still thinking about
New week, new opportunities. Welcome to Modern Investing Techniques, episode 39. Today is May 11th, 2026. I'm Patrick, broadcasting from Vancouver. Monday means fresh setups. Let's break down the week ahead and find our edge. Quick reminder, everything we discuss here is for education and entertainment. The practice investment of the day uses simulated trades with no real money. I'm not a licensed financial advisor, and this isn't financial advice. Always do your own research before putting real money to work. Energy holdings could tighten as oil jumps more than 2% after President Trump rejects Iran's latest ceasefire response, giving Canadian investors in the sector a clear geopolitical premium signal to evaluate today. North American indices opened higher, with the S&P 500 at 7,399, up 0.8%. The NASDAQ Composite sits at 26,247, up 1.7% today. The TSX Composite reached 34,078, up 0.7%. Sentiment draws support from earnings optimism and the sharp move in oil after the latest Middle East developments, 17 days after our TC key precious metals position closed down 2.94%. The episode underscored how quickly commodity supply narratives can shift without sustained volume follow-through. Investors should watch whether today's oil move broadens into broader energy rotation or stays contained to futures. The portfolio cumulative return stands at essentially flat with positive alpha delivered on the recent momentum trade, yet the overall book still trails year-to-date versus the NASDAQ. The ETF fee race leveling off shows investors shifting priority from chasing the lowest expense ratios toward total cost of ownership. Liquidity, tracking error, and tax efficiency inside registered accounts now matter more than shaving another 5 basis points. Canadian investors can implement this by screening for ETFs with tight bid-ask spreads and high average daily volume rather than headline fees alone. Then hold them inside a TFSA where tax drag is already eliminated. This approach worked best during the 2022 to 2024 rate hike cycle, when liquidity premiums widened dramatically on thinly traded thematic funds. The risk is overpaying for liquidity on products that rarely trade. The practical filter is to require at least 500,000 shares in average daily volume before considering an ETF for anything beyond a core long-term holding. Imagine you bought an energy ETF last week after oil spiked on geopolitical headlines and your order filled at the market open. The chart showed price sitting just above the 50-day moving average, with RSI 14 at 58, yet the next 2 sessions erased the entire gain. What actually happened is that the 20-day average volume was only 60% of normal on the breakout day, so the move lacked the institutional participation needed to hold the level. Moving averages, especially the 50-day and 200-day, act as dynamic support and resistance zones, rather than magic lines. A golden cross has shown positive forward returns in broad indices over multi-year periods. But the same pattern on single stocks produces far more false signals. Volume confirmation remains the single most reliable filter. Rising price on above average volume increases the odds the move is real, while declining volume on a rally is a classic warning. RSI above 70 or below 30 flags overbought or oversold conditions on the 14-day setting. Yet these readings frequently persist in strong trends. MACD crossovers add momentum context but lag in fast markets. The honest limitation is that technical analysis improves entry and exit timing far more than it predicts which stocks will fundamentally outperform. Always require at least one confirming factor, such as volume surge, earnings catalyst, or sector rotation before acting on a pure price pattern. Open your brokerage platform, pull up the 50-day and 200-day moving averages on one energy ETF you already own or are watching, and note whether price is above or below both. If it sits above the 50-day but below the 200-day, calculate the distance to the 200-day line as a percentage. That is your potential mean reversion target if oil holds its current premium. This is a simulated trade for educational purposes only. No real money is involved. Today's practice investment is a weekly hold in KGAI, Colibri Global Energy Incorporated, listed on the TSX as KEI and NASDAQ as KGEI. The strategy is a macro rotation play on rising oil prices driven by geopolitical supply risk. The catalyst is Brent crude topping $103 after President Trump rejected Iran's response to the U.S. ceasefire proposal, keeping the Strait of Hormuz risk premium elevated. Technical setup shows price action supported by sector rotation into energy names with volume expected to exceed the 20-day average on sustained oil move above $100. Risk assessment notes that sharp de-escalation in Middle East rhetoric could trigger quick oil reversal, so the stop loss is set at 8% below entry to cap simulated loss. The target is plus 4 to 8% over the 5-day hold if oil holds above $100. Confidence level is medium because the geopolitical catalyst is clear and the sector has shown rotation sensitivity, yet single commodity exposure carries elevated volatility without volume confirmation yet. This setup demonstrates how to size a macro-driven energy position around a measurable geopolitical premium rather than chasing headline oil prices. Last week's weekly hold was AMD as a momentum play on data center growth and AI infrastructure demand after an earnings beat. Entry came at $360.31 on Monday open, with exit at $408.46 on Friday close. The position gained 13.36% for a simulated profit of $133.63 on a $1,000 allocation. The earnings-driven momentum worked because data center demand exceeded expectations and sector rotation supported the move. The results still lag the broader index in cumulative terms. The extracted rule is to always require volume confirmation above the 20-day average before entering momentum trades on earnings beats. Wealthsimple now offers conditional orders and extended hour trading for Canadian and U.S. equities inside registered accounts. This gives TFSA and RRSP users the ability to set bracket orders that automatically protect gains or limit losses without monitoring screens all day. Intermediate investors who already hold positions in volatile sectors should enable these tools to enforce discipline on weekly holds. Access is available at no extra cost within the standard Wealthsimple Trade app for users with at least $1,000 in assets. The Trader Workstation API from Interactive Brokers lets users build automated scans that combine volume, moving average distance, and sector relative strength in real time. This edge is most useful for investors running multiple weekly holds who want alerts when a name meets all three technical filters simultaneously. Pricing starts at the fixed monthly commission plan, with the API itself free once the account is approved. HSBC lifted its S&P 500 year-end target on earnings optimism, implying roughly 3.4% upside from Friday's close, and signaling continued earnings support for large cap US equities. The action is to add a small incremental position to a broad S&P 500 ETF on any pullback below the 20-day moving average this week. Circle closed a $222 million ARK token pre-sale led by Andreessen Horowitz with participation from BlackRock and Apollo, valuing the new blockchain project at $3 billion. The action is to limit any new crypto allocation to under 3% of TFSA commodities value. The auction is to limit the beside exclusive data before a capital risk. Monday's analyst upgrades and downgrades from the Globe and Mail Roundup highlight fresh ratings across Canadian and US names, providing a daily filter for potential momentum or value candidates. The action is to cross-reference any upgrade with 20-day volume before adding to a watch list for next week's entry. Portfolio performance across 15 simulated trades shows a 47% win rate with 7 wins, 7 losses, and 1 break-even. Cumulative P&L sits at plus $0.01 with average return per trade at 0.00%. Best trade reached plus 13.36%, while the worst came in at minus 7.49%. Current streak stands at 2 wins. Our AI analysis is learning from volume confirmation patterns and adjusting entry filters accordingly. Before we wrap, tomorrow we will examine whether the oil premium broadens into sustained energy sector rotation and review any fresh earnings catalysts. That's modern investing techniques for today. If you found this useful, share it with a fellow investor and subscribe wherever you listen. Check the resources page for tools and platforms we discussed. We're back tomorrow. Keep learning, keep investing. This episode used AI voice synthesis of my voice. Editorial selection and analysis are my own.